Consumer caution and staff shortages caused by the Omicron outbreak underpinned a big drop in business confidence in the past few months. But there are clear signs that confidence is turning around, and fairly quickly. Now, that's according to National Australia Bank's monthly business survey, which is watched closely by the Reserve Bank. In January, the NAB survey says business conditions fell 5 points. The hardest hit component is the profitability of companies. But with state border reopenings, business confidence rebounded 15 points from those December lows. Joining me now, the National Australia Bank's Chief Economist, Alan Oster. Alan, always good to have a chat to you about these things. I mean, the National Australia Bank always watches business confidence. It's one of the real barometers of Australia's economy to show everything about investment, about potential wages growth, and even the price pressures that those companies are under right now.
I think that's right. Confidence is very important. We also look at actual outcomes. And so the key messages out of today were that confidence came back, as you were saying, not to normal levels, but it was a lot better than what it was. And conditions softened a little bit. So as you expected in December, Omicron is going to cause grief. You got the grief in terms of the profits, etc. One thing I think that was encouraging was that forward orders didn't really change and capacity utilisation improved. So I'd say, if I was summarising the survey, it was down as we expected, but it wasn't as bad as it could possibly have been. So it's sort of saying that business is thinking that Omicron ain't going to be such a big problem as we go forward. So that, I think, is good. And as you mentioned, also the other thing we're seeing is record high increases in purchase costs, particularly in sectors like wholesale and manufacturing, and that's flowing into goods. So we still see higher inflation coming forward.
Yeah, so one of the things this week is going to be US inflation out Friday morning our time, Thursday night US time, which could go to 40-year highs. The Reserve Bank says it believes because of a lack of wages growth that maybe the inflation story is different here in Australia. What do these numbers really start to tell you about that narrative that the Reserve Bank has got right now in terms of its monetary policy settings?
Well, I think the Reserve Bank's right. Because if you look at the US, the CPI, people are talking of 5.9, or in core something like 5, and they're trying to hit 2. Okay, so that's sort of where they're at. Whereas in Australia, inflation, they're trying to hit somewhere between 2 and 3, let's call it 2.5. They're currently at 2.6. Now, we think that in a couple of quarters' time, they might be 3.4. Reserve Bank thinks 3.2. But you put it in context, for the last 5 years, the core CPI hasn't got much above 1.5. So I think the Reserve's saying it is different, and it clearly is in Europe as well and New Zealand. But even so, it's saying that inflation is going to go to the top and maybe a little bit above the band. And so at some stage, they'll really sort of think about where they need things to be. But I think anything from August is live, but we still think the most likely start point for rate rises is November.
Is November. That's interesting, because one of the points about this is inflationary pressures inside businesses, and you're reporting today that they're still seeing cost increases. They've also got to be able to pass that through. Now, when there's a lot of competition, it's hard to pass price increases through. But of course, once you start to open that floodgate, that's when the inflation starts to build in the economy.
Yeah, the problem I suppose we all have is how much of this inflation is caused by supply pressures and how permanent is it? So I would suspect it's very much supply pressures, which is, if you can't pass it on, then that's a problem for your profits. But, in 6 months' time, will those supply pressures still be as bad, given that we're reopening the economy, et cetera, et cetera? So I suspect, we sort of think that after hitting 3-4, it might come back towards 3-ish. But by then, unemployment will probably be 3 3/4, and that might put a bit of wage pressure in. So we sort of have a view that, yes, you'll have some slowdown in underlying inflation, then wages will sort of keep it going next year, which is why we think the RBA will pull the trigger towards the end of this year.
And that's also because the ACTU, with minimum wage increases plus any enterprise bargaining agreements that come up in the meantime, are going to cite these increases in inflation to justify wage claims.
They are. Whether they get them or not is a different issue because, look, we think the wages data is picking up and soon it'll be around 2 3/4 to 3. But just at present, it's like 2.5. And that's assuming that we get a 0.8 in the December quarter, which we get in a couple of weeks' time. So it's still, hard to get wage rises unless you're in some sectors, as I said, a little bit like manufacturing and wholesale, very strong. If you look at personal and recreation parts of the economy, which think hospitality, it's about a third of the economy. They're not getting any wage increases at all. So business, I think, is a bit reluctant, having cut costs left, right and centre last year, the last couple of years, to actually pay wage increases. They're more likely to say, bring your dog to work, have all sorts of good things, we'll help you in other ways, but we're not sure we'll give you a pay rise. And that's what the Reserve Bank's sitting around waiting for.
It's interesting to know. Alan Oster, always great to have you on the program, and I appreciate your time today.
Thanks, Ross.